Good evening, everybody. Thank you very much for joining in. This side, Rahul Magan here is the Chief Executive Officer of Treasury Consulting LLP. And today we are going to covering another beautiful topic on our YouTube channel, which is options trading strategies, in which we are going to cover strapping. Now, strip and strap are the two best known option trading strategies which are used by the traders across the globe, because you don't know how the things would move. These options, and what we did this time, we not only created these option strategies, rather we have we are going to simulate it in front of you. So this is going to be roughly 15 minutes video. So we start with here. Now a strap is a kind of calendar spread. Now what do you mean by a calendar spread? A calendar spread is a spread wherein you would have the same expiration date and you would have the same strike rate. But I not consider this as a pure calendar spread. I say that you might have a same expiration period, which we are going to demonstrate to you, of course, but you should take up different strike prices for call and put in terms of moneyness. And so I repeat, a strap is a kind of calendar spread whereby an investor take position in the two long calls and one put. In a strap, trader keep the strike price and expiration date same. So what I did here, now before starting, let me tell you that strap is an option strategy whereby you think that market will move up more than down, because nobody can foresee the market. Nobody in this world can foresee the market, but you think that it would move up more than it would move down. So what you did, now here we mentioned that strap is two long calls plus one long put. Here you are taking two long positions in call and one long position in the put. So what are you doing? We are assuming that today's spot rate INR 68.30. 1 year forward premium, although it's trading at 2 rupee 50 paisa, but we taking it at 3 flat. So at the money forward is 71.30, which is sum of 68.30 plus 3, 71.30. Now historical balls for calls is 10% and historical balls for put is 12%. That I have taken from Thomson Reuters, which is sitting today. Right, historical balls for calls is 10% and historical balls for put is 12%. Now here is the call pricing. At the money forward is spot plus premium 68.30 plus 3, 71.30. Out of the money forward, at the money forward plus 1 volatility, which is 71.30 plus 10%, because here we are taking it 10%, because here we are taking the calls for 10%, 7.13, so totally 78.43. Call strike rate for option 1 same. So like a calendar spread, we are keeping for 1 year, however at the same time we are keeping the strike rate same. Remember the fact, you might ask a question or you might be thinking, why we are taking it out of the money forward? We are taking it out of the money forward only because of two reasons. Remember, this is not a range forward. Since it is not a range forward, wherein we have a cross like buy put and sell call, sell put and buy call, or range forward exporter or range forward importer. Since it is not a range forward, we cannot make it a zero cost collar. Since we cannot make it a zero cost collar, so we left with one option, which is highly diplomatic in nature, which is we need to reduce to zero premium. Almost zero premium. Please note, even if I increase this to 85, premium will never be zero. But yes, premium would be diplomatically reaching to zero. Now what I did here, I have taken this out of the money. It suggests that market is allowing me to buy for 1 year, sitting today buy for 1 year at 78.43. 71.3 at the money forward, but I wanted to buy from the same bank at 78.43. The reason is absolutely simple. The reason is that if I buy at the higher than the market, then of course I'm turning out of the money, and since I'm turning out of the money, my premium levels will fall. Since my premiums level will fall, I would be diplomatically speaking almost zero premium. So here I'm using a concept of a calendar spread here. Why calendar spread? I am keeping the maturity same, which is 1 year, 1 year from now, spot over 1 year, and here I am keeping at 70 strike rate same, which is 78.40. Now the biggest question for us is that, these all are option contracts. I hope those who are watching this video will get this term first time. Those who are already a subscriber of our channel knows very well. that options are always settled using Tokyo cut, and especially we are talking about Indian options, so it is going to settle at Tokyo cut. This is again Tokyo cut. So you have the Tokyo cut, which is 11:30 a.m. IST and roughly 3:30 p.m. Japanese time, which is published every day. Now, because you have this Tokyo cut in place, this Tokyo cut is going to be published 2 working days before the maturity. Now, this is spot over 1 year, and Tokyo cut will come 2 days before the maturity. So when the Tokyo cut will come, which is 11:30 a.m. IST or roughly 3:30 p.m. Japanese time, majority of the options are getting traded in that way. In that regards, you will decide whether you will go for the Tokyo cut or not. In this simulation analysis, we have taken 3 Tokyo cuts: 65, 75 and 80. Of course, we are going to explain this, but after explaining the put strike. In the put, again, at the money remains the same, spot plus premium, which is 68.30 plus 3, which is 71.30. Out of the money forward. Now, what is put? Right to sell. Market is allowing me to sell at 71.30, but I wanted to sell it at 64.17, which is out of the money. So out of the money forward is 64.17. So my put strike price would be 64.17. I repeat, strap is an option. Strap is an option strategy whereby you think that it would go up, then going down. Of course, even Warren Buffett cannot say that all his predictions turn true. He himself acknowledged that some of the investments he did during 2016 that went wrong. So nobody can predict where the stock market will boom. And considering the fact, the kind of volatility you are facing in the market, it is going like anything. You don't know, anytime anything can happen. So henceforth we are keeping a provision of both. Yes, do remember that if we calculate this as a back spread, then it is 2:1. I repeat, put, call we are taking out of the money, which is 78.43, and put we also take out of the money, which is 64.17. Here comes the scenario analysis which we did for you. Because we did it for INR, if any exporter or any importer is buying this, then importers can have a look with that regards. Assuming the Tokyo got published at 65, let us start from the put. Would you sell if you do sell to bank at 64.17 if the market is at 65? No. You wait, let me write this. Put call 1, call 2. Would you sell at 65 if market, would you sell at 64.17 if the market is at 65? No. You let it worthless. Because you let it worthless, then you would have a gain. And then that gain is roughly 83 paisa. Call option number 1, which is here. If market is at 65, would you buy from the bank at 78.13? No, you would always buy from the market. So here you again getting a notional gain of roughly 13 rupees and 43 paisa. Similarly is the case here, 13 rupees and 43 paisa. So approximately gain of 27 rupees during this transaction. Approximately gain of 27 rupees during this transaction. Another, if market is at 75, would you sell to bank at 64.17 if the market is at 75? No, you let it worthless. Here again you are getting a gain of approximately 12 rupees. In call, would you buy at 78.43 if the market is at 75? No, you will get a gain of roughly 3 rupees 43 paisa and 3 rupees 43 paisa. Roughly 19 rupees of gain to you. Now here comes 80. Would you sell at 64.17 if market is at 80? Definitely not. You let it worthless and approximately 16 rupees of gain here. And here in call, would you buy at 78.43 if market is at 80? Yes. Here you will get a gain of roughly 1.5 rupees and 1.5 rupees. So roughly 19 rupees of gain here. Now imagine if you are an importer and you have some positions which you wanted to nullify, which is in our language is known as natural hedging. So you're left with two options. Either you can naturally hedge that against import against export, or either you can create a strap. If you create a strap, believe me, INR go anywhere, you would always have a gain. But always remember one fact, that straps should always be created out of the money forward. Don't create strap at the money, because remember that strap is not a range forward contract, because at the end range forward can turn out to be a zero cost collar, but strap will never turn out to be a zero cost collar. So always create a strap out of the money forward, and if you create the strap out of the money forward, even if INR will 65, 75 or 80, you would always be in a gain, you would never be in a loss. This is the purpose of the video. We thank you very much for that. You're always welcome to visit our website www.treasuryconsulting.in. Our mobile number is 9899242978. My Skype ID is Rahul5327. And you can have my email ID rahul.magan@treasuryconsulting.in. rahul.magan@treasuryconsulting.in. You are always welcome to call us in case you have any kind of consulting projects, you want any training. If you are a corporate, if you are an education institute, we are imparting trainings within and outside Asia, within and outside India. We have our online academy, which is TR Consulting, which is giving a lot of online training programs. In fact, one of the videos for the today would be covering that. We have covering more than 16 online programs, and I hope by the time we end up roughly in March 2017, this 16 would cross to 25 online programs, and hope by end of this year we would have more than 50 online programs to be offered almost every domain. You always welcome to connect with us. We thank you very much, and have a good luck.